Welcome to the PSG Wealth Local Solutions webinar for the month of March. And this presentation just looks at, or focuses rather, on the PSG solutions. The flow of the presentation would actually look at the market, the market update, where we look at different asset classes, just both locally as well as offshore, over a 1 month period, and thereafter looking at a 7-year period, just looking at how the performance has been. And then we'll obviously dive into the solutions, just looking at how the solutions have performed, given that different asset classes had performed the way that the graphs will show. And then thereafter, we'll just look a little bit deeper into the solutions, where we look at over the recommended investment period of the solutions, what really was the return, and thereafter amongst the underlying funds or managers that we use, who amongst them was able to lead and who amongst them were able to lag in each respective solutions. So just as explained, looking at the asset returns, and these asset returns are in Rand. We look at both local and offshore. What we then see from this graph is firstly is that we have two conservative asset classes, that being cash and bonds, and we also have aggressive asset classes referring to property as well as equity. And over just the period of 1 month, which is March, we see a mixed bag, but one thing that's common, or a common trend amongst the two, is that aggressive asset classes were managed to outperform conservative asset classes for the month of March. And this is both true for offshore as well as local, with conservative really taking a knock there. Over a longer investment period, we have a different story. So in this different story, what we then see is, starting with offshore, is that the more aggressive continued to outperform the conservative asset classes, cash and bonds. Whilst on a local front, this is where the different story comes in, where we still see that local property has taken a knock and continues to take a knock even over such a long investment period, and returning a negative 1.17%. Now, just looking at the solutions and the ranking, I would like us to firstly pay attention to since inception rank, which is the furthest column on this table. And what you then see is the solutions since their inception have managed to return an above average return for our clients, with from the least to the most aggressive portfolios ranking 1, 6, 9, 9, 10 respectively. Whilst when we then look at further for longer periods of time, maybe thinking of the previous graph that we looked at, a 7-year period. And in this case, I would like us to now pay attention to over 4 years and about 10-year rank. What you then see is that we still continue to return an average and above average for our solutions. And that does look good. Nevertheless, within investments, we also understand that within a shorter period of time, there will be market volatility. Whilst even though in the longer investment period of time, you see that smoothing out and really looking at proper trends that are taking place. The solutions are no exception to what the financial market would deliver within a short space of time, which is volatility to our clients. And this is we come true, and then we look at the period less than 4 years, going under till 1 month. And what's very clear is that there is volatility within the market, and that has filtered through into our solutions. But is it something that our clients should be concerned about? I think from us as a team, as a professional team that regularly evaluates and regularly reviews our portfolio solutions, looking at our investment philosophy, our investment process as well as approach, we do have faith that the way our portfolios are structured, we will be able to keep to our 3 pillars, which is having portfolios that will consistently be able to have risk that is managed below the average risk, and also us being able to provide value for money to our clients. Just now going into what we had mentioned in the beginning, that we'll look at the minimum investment period, which is recommended for each and every one of our solutions. And we'll then look at which fund really was top or led, respectively within the portfolio, the other underlyings, and which one led. Starting with the PSG Wealth Enhanced Interest Fund of Fund, we can see the Coronation Java Plus led the underlyings, with PSG Enhanced Interest lagging. But over the recommended minimum investment period, the fund managed to deliver a 4.78%, which is above inflation, meaning that we were able to return to our clients real returns. With the Income Fund of Fund having Momentum Income Plus leading and Coronation Strategic Income lagging. And over a period of 2 years, which is the minimum investment period that's recommended, the fund managed returning about 13% to our investors. And the Preserver Fund of Fund had Sim Inflation Plus leading, with 91 Cautious Managed Fund lagging the underlyings. And over the recommended minimum investment period of 3 years, the fund managed returning a 6.25%. Now looking at the Moderate and the Creator, both of which have a recommended investment minimum period of 5 years. The Moderate has the PSG Balanced leading the chart, with the 91 Opportunity lagging the underlyings. And over the minimum investment period, having a 6.11% return. And last but not least, being the Creator Fund of Fund, which has the Old Mutual Investor Fund, as well as the Coronation Investor Fund, respectively leading and lagging within the portfolio amongst the underlyings. And over the recommended minimum investment period, they have a return, or it has a return of 7.48%. And just below, we have the 3 funds which were added for the month into the quantitative radar. And these are funds that somehow have lagged the sector over a period of 1 month, 3 months, 6 months, as well as 1 year. And these are 91 Cautious Managed, 91 Opportunity Fund, as well as the Sim Balanced Fund. Still, is it a concern that our investors should have? I think given the quality of the team and any other structure that is involved within constructing these portfolios, monitoring these portfolios, reviewing these portfolios, I think that we still have a strong belief and a strong ground believing into our investment philosophy, investment process, and the approach that we take in investing in these fund managers. And as a result, and given consistent reviews, we still have faith that each and every one of our underlying managers within each respective portfolio has a role to play within the portfolio and will be able to help us deliver consistently above average return, well managed risk or below managed risk compared to the average, and also us will be able to provide a competitive fee to our clients. With all this being said, I would like to thank you.